This is video 3 of example 11 dealing with the category financial liabilities at amortized cost. Let's have a look at the journal entries, and the first entry happens on initial recognition, the day that Annika Limited issues the debentures, which is 1 January 2011. So when Annika Limited issues the debentures, they do that to obtain a bit of financing. They could also have gotten financing by issuing more shares, or they could have gotten a bank loan that they have to repay. They chose to issue a debenture. So the amount that they received when they issued the debenture, the bank amount, debit bank, will be the 95% of nominal value, because this debenture was issued at a discount. It was issued at 95, different way of saying it. It was issued at a discount of 5%. So they won't receive the full nominal value of 1,000 Rand. They will only receive 950 Rand. Is that fair value? If we think about the rules of financial instruments, all financial instruments, including financial liabilities like a debenture that is issued, need to be recognized initially at fair value. Always, always, always fair value. Is this cash amount the fair value? Well, it could be, but we can't assume that it is. We will need to go and check and work out what is the fair value. It was not given to us. They didn't say the 95 is fair value, and they didn't give us the fair value. So the way we do that is by taking future cash flows, discounting them back to PV by using a market interest rate, and that PV will then represent fair value. That might be the same as the issue price. It could be, but we will need to go and check. So if we look at our calculations of the cash flow, the first cash flow that happens is on day 1 January 2011. We issue the debenture at 95%, so there's a cash inflow of 950 Rand. We also then pay transaction costs to our broker, so there's a cash outflow of 75 Rand, which means there's a net cash flow of 875 Rand. We are actually at this moment not interested in the day 1 cash flow. We want to have a look at the future cash flows, so that we can discount those future cash flows back to PV. PV is day 1. We don't want to know what the cash flows were on day 1. We want to calculate the PV, which represents the fair value. So we need to go and have a look at our future cash flows. Now to do that, we draw a little timeline. That would be 2011, 2012, and 2013. In 2011, there will be only interest because they told us there is no maturity payment in the first year. In 2012, there will be interest again, and then on 31 December at the end of 2012, we have our first maturity payment. In 2013, there will be interest again, and at the end of the year, that will be our last maturity payment, the second maturity payment on 31 December. So if we now have a look at our cash flows, year 1, 31 December, what would we have earned? We would have earned interest throughout the year. How do we calculate the cash interest? Nominal value times nominal rate, which would be 100 Rand. It is paid by the issuer. It's finance cost for the issuer. If we go down the timeline some more and we get to the second year, 2012, at the end of that year, again, we would have earned interest. nominal value times nominal rate, 100 Rand issued, 100 Rand interest that the investor will earn, that the issuer will need to pay. If we look at the end of the 2012 year, we have our first maturity payment. The nominal value, half of it, matures because we repay this debenture in 2 equal installments. So half of the nominal value will be repaid now. Does it get repaid at nominal value? No, it is repaid at a premium of 10%, or another way of saying it, it's repaid or it matures at 110%, which means our maturity payment will be 550 Rand. That will be the same at the end of 2013 because it matures in 2 equal annual installments. So the second maturity payment and the first maturity payment is exactly the same. If we then go down the timeline, we get to the end of 2013, we will have earned interest throughout that year. Now have a look at this interest calc. It is 500 Rand times 10%, and it's only 50 Rand interest. That is not the same as the interest that was earned in 2011 or 2012. But we said the cash flow interest is nominal value times nominal rate. Why is this then different? The debenture has a nominal value of 1,000 and a nominal rate of 10%. Why do we not have 100 Rand interest in 2013? Because half the nominal value has been redeemed. It matured. It is no longer outstanding. The issuer has repaid the investor. So they won't pay interest on a part of the nominal value that was already paid back. The investor doesn't earn interest on the capital he already received back. The interest is earned on the outstanding nominal value. How much nominal value has not matured, has not been repaid? That part will incur interest. And how much was that? Half of the nominal value, because half had already been repaid. So half of the nominal value will accrue interest over the 2013 year at the nominal rate of 10%. And that is why the interest is different in 2013. What is important to see is that your payments that happen every year, the interest amounts, are not the same every single year. Therefore, we will need to use our cash flow function on our calculator when calculating the PV.